What is going on, everyone? Welcome to our Finance Tuesdays. We are on part 4 of the Blueprint to Financial Freedom. We are going to continue on planned expenses. We want to make sure that if there's an emergency coming up, we want to make sure we have proper coverage. Last week, we talked about having 6 months of reserves. When there's a job loss or our income suffers, we want to make sure we have coverage for our everyday expenses, right? The next thing we talked about was liability insurance and umbrella insurance, because again, if something happens that's out of our control, we want to make sure we're covered, right? So today we're going to talk about other expenses we need to be thinking about planning for. So I talked about the sacred accounts of life insurance, dividend paying policy, and they have a death benefit, right? So that death benefit is there when you die and it's passed on to your family member, right? So this one's passed on to my wife. Now, right now, in my mind, I'm trying to continue to get out of debt. Now, I also realize, I still have to take care of those things. So if anything ever happens to me, I have to make sure that those coverages are still intact. I'm not rushing to buy a house right now. You're probably like, why don't you buy a house right now? Well, that mortgage is $200,000 and I got additional debt I need to take care of. I don't want to add that on top of it. It doesn't make sense. The math does not add up for my family right now. So what am I doing? I'm going to take care of my consumer debt first, knock it all out. And once that's done, start considering a house, right? But again, I'm not even thinking about that right now, not considering it, right? So the first thing you want to do is think about the long term. Think about things that are happening in your life right now and take care of the things that need to be done. Like if you got consumer debt, knock it out, get rid of it. Don't rush anything else. Take care of that because there's going to be other expenses down the road that you want to be in position to take care of, right? So that's why I'm waiting to get a house, not rushing that at all. So when you have what's called a funeral, because you will die eventually, it's going to cost between $15,000 to $20,000. Well, my death benefit will take care of that, but I have to make sure I have enough in there left over. So if I have enough left over, that's a good thing. If I don't, that's a problem. So that's why you want to have a life insurance policy with a large death benefit so your spouse is taken care of. Because again, I don't want my wife in a position where she's got to pay for a mortgage and my funeral and she doesn't have a lot left over to start investing. I want her to have more money so she can invest so she's good and she's protected and she's good to go. That's why I think this way. The next thing you want to think about is health insurance. I know health insurance can be very expensive. And again, all this happens, just to be clear, all this takes place after you have zero consumer debt. You don't start buying all this while you're trying to get out of debt. You're trying to lower that, get out of it so you don't have to worry about it anymore. So this next stage with the health insurance, there's two things you can do. You can get the minimum coverage, which it's set by the government. The premiums are between 30 to 50% lower. And by the way, all these ideas I'm getting is from the Blueprint to Financial Freedom, by the way. So pick up this copy today because it's super, super helpful. It's helped me out a lot. Even as I'm reading it again, it's just giving me new things I can apply. And so make sure you go check that out. I'll leave the link in the description. So yeah, health insurance. So you can get the minimum coverage. The premiums are lower. Taxes are lower. And you can actually contribute to a health savings account, even if you have the minimum coverage. You can add some like dental, some vision, some prescriptions, and it's not going to cost you a lot. So you can get the minimum coverage and it lowers your premiums and you still have something for health insurance, right? And the next thing you want to make sure you have, if that doesn't work, you can also get, they call it like a shared membership where people contribute to a fund. And if somebody gets, has a medical situation going on, they just pull from the funds to get that taken care of. It's an organization, you have to have shared values, but if you have that at your company, that's something you can actually get involved with, and that can help everyone out with the health insurance. The next thing you got to make sure you have is make sure you have coverage for auto insurance. If you don't, then man, that bill is going to be really high and it's going to put you in a tough spot. The next thing you got to have also is homeowners insurance, renters or homeowners. Why? Because if something happens to your property and you're not properly covered, guess who has to pay for those things? You do. You're not covered. You're now held responsible. So if our income is not greater than our expenses and assets, and if our expenses and assets are not greater than our liabilities, we're not solvent. We're not truly solvent yet. So if we're going to be properly solvent, we have to do things in the right order because you can't skip steps when it comes to financial freedom. If you're skipping steps, it's going to bite you in the butt and you don't want to do that to yourself. You want to make sure you are focused. You want to make sure that you are just taking the right steps and you're not skipping anything. Because again, I could go out, sometime because I'm paying my car off in January. That's going to help, with my debt. But I also understand I don't need to rush to buy a house. I don't, because I also understand it's going to whatever the loan is, it's going to cost you 1 to 4% on average for maintenance each year. So minus 1 to 4% each year off the loan value of the house. That's how much you are paying in maintenance on a yearly basis. If I don't have enough capital right now and I'm still dealing with consumer debt, that doesn't make any sense to me. That's a bad move. And I need to wait. And now we'll talk about why you shouldn't get a mortgage in another video, but that's another video for another day. But again, you want to think about these things now, because I don't want to put my wife in a position where if I have a mortgage and we still have some consumer debt, like student loans to take care of, or have one more car loan to take care of, I don't want her just taking all the money from the death benefit and just paying the mortgage in that as well. I don't want to do that, because I want to make sure there's as much death benefit available to start investing. Because once you're debt free, what's the next thing you do? You get the coverages you need here, then you start investing. But I can't do that if I'm just giving it, away like that. It's just not a good move. So it's just stuff to think about, stuff to consider. If you haven't already, make sure you subscribe. Make sure you leave a comment. If you got questions, ask your questions. Make sure you like the video. And if you want to check out the other videos of the Blueprint to Financial Freedom, make sure you go check those out now. And I'll see you in the next video.